Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This video represents the first in a series of videos where I'm going to cover high-profile or very popular stock. The first stock I will be covering with this video will be Nvidia. The underlying theme of this series of articles will be forecast profits, not prices. And what I'm really going to be talking about is the importance of forecasting future earnings in order to try to get a good handle on what you might be able to earn by investing in a given company at a given valuation. So let's start, as I mentioned in the write-up with this series, let's look at Nvidia's history. And what I have on the graph here are earnings per share and then dividends while they were still part of the company, which indicates the dividend payout ratio below this white line, and then dividends after they've been paid out, which is the light green shaded area. There are a couple of things that are very striking about this long-term graph, and I talk about this in the article. You can learn a great deal from the past, but as I point out, you can only invest in the future. So let's just take a quick look at Nvidia's history. As you can see, there's a moderate amount of cyclicality in their company's earnings. This orange line is a fair valuation PE ratio reference of 20. So anywhere you point to this orange line, you've got a 20 PE ratio, which equates to the company's earnings growth rate historically over this time frame. But I want to point out it's been somewhat lumpy. But here's the thing that's most striking about this. In addition to the fact that they started paying a dividend in 2013, although their yield is less than 1%, the striking thing is to see this acceleration in growth. And if I shorten this time frame here and drop it down, you can see that growth over the last several years. In 2015, they grew earnings at 43%. And their fiscal year ends in January. In fiscal 2016, they grew earnings at 18%. And then in fiscal year 2017, which ended January 2017, earnings growth was 83% and is forecast to grow by 32% this year. Now, when you get into these forecast growth rates, this is where the rub with Nvidia comes. But what I think is really important here is to notice this huge acceleration in growth. So if I drop this down to a shorter graph, and keep in mind I've got 3 estimate years in this particular iteration, you can see that earnings growth would be 31%. Now that changes the PE of this orange line to a PE of 31. So let me bring monthly closing stock prices into the equation here for a moment, just to give you a perspective of how earnings follow stock price over the long run. So I'm going to go back to the all graph where we had the 20% growth and a PE ratio of 20, and I'm going to add monthly closing stock prices. And what I want you to notice is how the stock price in the longer run tracked earnings almost perfectly. Now there were periods where the price got significantly above earnings and the PEs got very high, like we did in January of 2002, once again in October of 2007, before we came into the recession where we had a couple of years of negative earnings growth here. But I do want you to see these periods where you have these very high rates of earnings growth, and then price again tracked earnings pretty well, and then we've had this acceleration. Now when you look at it from this long-term perspective, Nvidia looks massively overvalued clearly. But if I drop that down once again to a shorter time frame where earnings growth has accelerated to 33%, and I'm now using a PE of 33 as a fair valuation reference, Nvidia still looks overvalued, but not as dramatically as it did before. But I think the important thing here is to recognize that earnings growth was 83% in fiscal year 2017, and is expected to be 32% this year, and then it's expected to slow down a little. And this is really where the rub is. How good are these numbers going forward? Now before I get into that, let's just look at a couple of fast facts here. The company's PE ratio, and this is a blended PE ratio, is currently 44. That's part past and part future, which is why we call it a blend. They have a low dividend yield of 4%. The company's a $96 billion market cap. It's BBB- rated, which is barely investment grade by S&P, and it has 24% debt to capital. So those numbers all look pretty good. The real key is, what does the future for Nvidia really hold? However, before I go into forecasting, let's just go into the company's website and take a quick look at what everyone's so excited about with Nvidia. About half of their earnings and revenues come from gaming, but they're also a big player in artificial intelligence, and the graphic processing units is a big business. Data centers is another, but the real key point here is that this company is currently very well positioned. In fact, first player in a lot of these these various aspects. And these are all potentially enormous growth engines. So you can see why people are excited about Nvidia. But as promised, let's run some forecasting what-if scenarios on Nvidia and see what we can determine based on growth. Now, the first thing I want to point out is that it's a reasonably well-followed company. There are 26 analysts forecasting earnings growth for this fiscal year, which ends January 2018, and fiscal year 2019. Earnings growth for this year is currently estimated at 32% and 13.3% for the following year, followed by 19.6 and 19.3. However, we get a lot fewer analysts here. So this would be an average earnings growth of about 20.6%, which is what the PE of this particular orange line would represent. And that would represent a reasonable fair value if, in fact, the company grew at that rate. The 3 to 5 year growth rate is a little more mooted. There are 9 analysts reporting to S&P Capital IQ that forecast 15.45%. And I also checked with Morningstar analysts. There are fewer analysts in that universe, but they're forecasting 14.5%. So these numbers are pretty consistent depending on what analyst you actually survey. However, in order to kind of develop some credibility about analyst estimates, we go to the FastGraphs analyst scorecard here. And we have 2 scorecards. We have one where analysts were making an estimate 1 year in advance, and then we have one where they were making an estimate 2 years in advance. And we give them a 10% margin for error for 1 year forecasts and a little more, or 20% for 2 years. So let's look at how accurate analysts have been for 2015, 16, and 17. There were 23 analysts forecasting 92 cents on January of 2014 for 2015. The company came in at $1.42. That was a 50-cent beat, or a 35% better result than analysts had forecast. In 2016, analysts were forecasting $1.41. The company came in at $1.67. That was a 26-cent or 16% beat. And then in 2017, analysts were forecasting $1.70. The company earned $3.06. That was a $1.36 or 44% beat over what they were forecasting. So one thing that this company has been doing is significantly underestimating or underguiding and beating analyst estimates by a rather large margin. But let's try to put some realism into some of those numbers. I've seen reports, articles written where analysts are forecasting that the company will earn $5 or $6. I'm going to use $5 a share for 2018, or in other words, a significant beat relative to what the analysts are forecasting. And then as far as growth rates concerned, there are those who think the company can grow at 30%. So I'm going to take this consensus long-term estimate of 15 and I'm going to increase it to 25. I'm not going to go all the way to 30, and then I'm going to go ahead and run those numbers. Now, is this doable? That's a question that each of you have to ask for yourself, but at a 25% growth rate, Nvidia, if it traded at a fair value PE of 25 going forward, so we had PE contraction, would still be a moderately decent performer longer term. However, that's a big if, as whether they can generate this kind of earnings growth. If I change that number to 30%, like some people think, and all I'm doing here is what-if scenarios, so if I change that growth rate to 30%, and now the fair value PE I'm using here is a PE of 30, then you can see that this company could generate some very positive rates of return. However, at the end of the day, I think it's important to recognize that this company has had a tremendous run-up. From January of 2016 to yesterday's close, the company's up has almost doubled in that, we'll call it 1 3/4 year time frame. And so the real question is, how overvalued, if any, is Nvidia based on the future opportunity? I think this company is worth taking a closer look at. However, I do think it's imperative to understand that earnings growth for this company and the forecast for earnings growth when you're already a $96 billion market cap is going to be quite a challenge. If you run some of the most recent earnings growth rates, however, Nvidia would actually be undervalued. I'm using historical growth here, not analyst estimates. So this is a very interesting company. It's very highly valued right now, regardless of what growth you put in, which means that it would have to execute perfectly in the future for it to generate any real rates of return. But the stock is clearly hot, and it's hot for a reason. It's hot because earnings growth has accelerated dramatically and is expected to continue. So this is a high-risk growth stock, in my opinion. The valuation is high relative to what it actually has accomplished. The real question is, what do you think it can accomplish in the future? The company does produce some awful good fundamental numbers. Here I'm taking a quick look at gross and net profit margin. I want you to notice that the company's had a big acceleration in the 2017 year from a standpoint of net margin. Their net margin is almost doubled, and that's also another reason for a lot of optimism. Another thing I'd like to look at real quickly here is just take a look at what they've been doing recently with shares. They've actually issued shares, which I think is reasonable in fiscal 2017, considering how hot they've been and how hot the growth of the stock has been. And then finally, I want to take a look at revenues here. And this is really where the story is recently. Revenue growth recently has been accelerating quite dramatically and is expected to continue. There's a lot of opportunity for this stock, but I would suggest caution. This is a very highly valued stock that is, hitting on all cylinders right now, and it wouldn't take much for that to change. So invest with caution if you're going to invest, but be aware of what the valuations actually look like. This has been Chuck Carnevale saying thanks for watching.